Hey, what's good, everybody? It's Mikhail. Just want to thank you all for the support, the likes, the interest from my first video, the fundamentals and the basics of options trading. It was a huge success, and this second video is basically a follow-up to it. I'm going to be teaching you some tips, some terms, some strategies of how I execute trades properly. And in the process, I hope that you take lots of notes and you really understand how to be disciplined, because discipline is number one. And if anyone has not seen that first video, please, please, please share that with them. Make them take lots of notes as well, because this options game can be financially life-changing. And I'm here to help you guys. So please keep the questions, the comments, the likes coming, because I have nothing but time, guys. So good luck, and let's begin. Okay, so I want to start off by saying the top 3 questions I've received so far from all the posters are: yes, you can buy an option contract even though it expires a month from now, a year from now, 6 months from now. You can buy that option contract today and sell it today. You can buy that option contract today and it expires 6 months from now, sell it tomorrow. You do not need to wait until the expiration date to sell your contract. I need to clarify that, because I've been receiving a lot of questions regarding options and expiration dates. So yes, you can buy an option contract expiring next year even, and you can sell it the same day. You do not need to wait for that expiration date. You are not in a contract for the entire term of that contract. So yes, you have the freedom to buy a contract today, even though it's a year from now, and sell it the same day. Second, I do not invest in any stocks under $5 or in the $5 range. Those to me are considered penny stocks. I would advise you to also not be invested in those cheap stocks, because they are highly volatile and they do not go with the same regulations that the blue chips, basically the standard of the blue chips, are. And the third thing I would say is please try to purchase a strike price close to the current price as possible. That will help you, and the gains may not be as significant. You may get a 20% day instead of a 100% day, but guess what? A 20% day is much safer. Big picture, guys. So please remember those things. You could definitely sell your contract anytime you want. It does not have to be till the expiration date. Do not mess with any stocks around the $5 range or under. To be honest, $10 or below, stay away. It's not worth it. And the last thing is, you have to basically stay as close as you can to the price of strike. Don't leave that strike price. If you don't know what a strike price is, watch my first video. If the stock market is the main bet, options market is the side bet. And what I mean by that is, you may not think that the stock market is correlated to the options market, but it is heavily influenced by the options market. The reason why the options market plays such a difference in the regular stock price is because of Fridays. Fridays are every option expiration date. You should know that from watching my first video. So when a Friday hits, typically if the stock market has been, say, green, and we've had a bullish run this whole time, every day that stock is going green, 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 when you come to a Friday, there's usually a significant sell-off. Why is that? Because the market makers have sold those contracts and they want the strike price not to hit. So those option contracts expire worthless. So what I'm saying is, when you bet weekly stock, or option expiration contracts, bad idea, because typically the stock drops, or if it's a bear week, the stock will rise. The side bet, which is the options market, always dictates the main bet, which is the stock price. So if you want to just play it safe, buy the stock itself. But what I'm saying is the side bet, which are the option contracts, those always get hit on Fridays. So on Fridays, do not usually bet until the last 5 minutes of the day because you will probably get burned. Option contracts get burned weekly. It is a very, very savage game, and you have to know this. This is very due diligence that I've learned over the years, and my team has. We've done the data, the research. We know Fridays, that's options burn. So if you have a stock at $100 and you had a contract that expires this Friday at $103, most likely that contract won't hit at $103 because the options burn. They collect that whole contract and you expire worthless. What is due diligence, or DD? So DD, or due diligence, is basically research. Finding out the in and outs of that company. What are the earning reports? Have they missed earnings? What is their revenue? What is their gross margin? What is their loss compared to the previous quarters? This is due diligence. This is called DD. So when you hear about this, very, very carefully take your magnifying glass, look at the company financials. It's in basic math, English. So when you see a company that you think is undervalued, say like Microsoft, when Microsoft is trading at $180, hey, they're one of the best growing companies in COVID-19. So guess what? Microsoft is trading up because companies still use their products, their software. So Microsoft is rising. Now Microsoft is over $200 because they are able to stand the test of time. No matter what significant downpour may happen, Microsoft is holding their own. That's DD I've done. Due diligence I've done. The same you have to do. If you believe in a company, do that research. Investigate these companies. Make sure you know who the CEO is, what their priority is, what their revenue is, what their long-term goals are. And from there, you will make better financial decisions. So daily on the stock market hours, we have two time frames that are very significant. Two. The first is called the lunchtime dip. The lunchtime dip, that occurs if you're on the West Coast, LA, stand up. That's between 9 a.m. and 10 a.m. So East Coast, 12 to 1 p.m. That is the time when you want to enter a stock or an option contract, because typically, apparently, the stock market dips, and I've done my research. It does dip during that time period. So between the hours of 9 a.m. and 10 a.m. every day, you will see a stock market dip if you're living on the West Coast. So from 9 a.m. to 10 a.m. again, you will see a dip, and that dip is called the lunchtime dip. So if you ever want to buy or enter a position, I highly recommend you getting in that time. Second, it's called power hour. Power hour is the final hour of the trading bell, the last hour of the stock exchange. So from 12 o'clock to 1 o'clock, that is power hour on the West Coast. Good luck, guys, because usually the stocks climb. Power Hour has significant buying opportunity. I think people believe that the stock is going to keep on climbing the next day. So because of that interest, the stocks climb. So we have two categories. We have the dips when it is at 9 a.m. to 10 a.m. West Coast time. That's called the lunchtime dip for the East Coasters. And from 12 p.m. West Coast time to 1 p.m. West Coast time, that's called Power Hour. And it makes you happy because sometimes it's just huge buys. And if you're playing options, you are making cash. You're printing cash. So good luck, guys. These are the 2 hours that really matter. If you want to buy on a dip, 9 to 10 a.m. If you're trying to sell on a market high, sell it during Power Hour, guys, between 12 and the close, 1 p.m. Los Angeles time. Corrections. So I can't tell you when a correction happens because this market has been so just unpredictable. But what I can tell you is this: stocks do not continuously go up. So when there's a correction, what it means is the stock will climb, and then at some point it will pull back. So I cannot give you an exact precise moment. I cannot give you a precise indication of when a stock has corrected, but expect it. That's what I'm gonna say. Expect it. There is no way I could, it's impossible. But there will be a correction. And don't ever get too happy. If you are at 3 days of green days, cash out, guys. Take your money and run because you will be able to buy at a lower price. There's always going to be a pullback. There's going to be some kind of market correction. Do not ever fall in love with just the stock climbing. It's not reasonable. It's not real. And if you're able to identify that, more power to you because you've learned that the stock market is just, it's not continuously bullish. It's not going to go up forever. So if you find yourself in a position where you've had significant gains, cash out, guys. Cash out and come back in. Re-enter. That's all I'm going to say. So my favorite topic, taxes. Everyone wants to make a lot of money and they want to cash out, buy their new truck, buy their new house, buy their new wardrobe. Guess what, guys? You make your money if it's on stocks or options or whatever you want to do, margin call, whatever it is. Guess what? That stock, if you hold it for less than 1 year, you're getting taxed at a capital gains tax. Capital gains tax is 40%, people. 40%. So you want to cash out 40% if it's under 1 year. Now, hold it for more than 1 year, it's a 20%, 20 capital gains tax if you hold it for more than 1 year. So you have the decision. Do you want to cash out quickly? Or you want to hold it for a year? Up to you. Me personally, I'll tell you the truth. I like to collect my money and I run the opposite direction. So I like to have short-term capital gains tax. So I'll be taxed at the highest level, 40%. It hurts. It hurts. But guess what? That's profit secured. So good luck, guys. Do not think that, hey, all the money you collect is your money. It is not your money. Uncle Sam, he collects it. Joe Rogan, he calls him Big Daddy. So,
Gay!
you're gonna pay Big Daddy his fair share before you collect and before you eat. So if you're prepared to invest and you're prepared to make income off of stocks or options, be prepared to pay taxes. Short-term capital gains tax, easily 40%, depending on what state you're in. So talk to a financial advisor. Long-term, 20%, more reasonable. Again, talk to a financial advisor. They'll give you the proper rates, but that's off the top of my head, guys. First thing I'm going to give you off the top of the brain is you have to be able to have an entry point and an exit point. So establish yourself with, this is my max pain tolerance in terms of losses and max profit tolerance. Me personally, if I lose more than 20%, I'm selling. If I gain more than 40% in profit, I'm selling. That's my limits. My limits have been established and I have been successful in those methods. So right now, when I see a contract and I see that I'm negative, say 20%, 25%, I'm cutting my losses, guys. I sell. Same thing. If I'm up 30, 40, 50%, there's a high likelihood I'm selling already because I'm securing those profits. I cannot risk the chances of losing money. So have your entry point, have your exit point, and that's how you execute your goal. Be disciplined. And if you are disciplined in where you know you want to be, no problems, guys. No problems. Just know it's a strategy. Swing trade. I'm going to go first. If I buy a stock today on a Monday and I sell on Tuesday, that's called a swing trade. So if I buy a stock at $100 and I sell tomorrow at $103, swing trade. No day trades required. Simple. Second thing, what's a short-term trade? A short-term trade is you see opportunity. If it's a stock or a call option and it's in your range or in the money, you buy that option call within that expiration date. And short-term, it typically hits. The markets have been so beautiful to the majority of us. So write it up, have confidence, chips in the middle, and you're going to pay that tax, like I mentioned in the previous clip, but you will make money and you'll be happy. So play the game. That's basically it. Final topic, it's the earnings report. Have you seen the first video? If you haven't, watch my first video about the fundamentals and basics of options. And basically, I speak on earnings and earnings reports. And what I'm going to tell you about earnings reports, which I didn't go into in detail, but the first video is earnings reports. When it comes up, you buy option contracts maybe 2-3 weeks out from the actual earnings date, if that makes sense. I hope it does because you watched the first video, so you should know now. So when you pick that earnings option contract, you sell on the hype leading up to that earnings date. So for example, if Nike reports on Thursday, we will buy contracts for Nike the previous week. And what happens is we will sell on that Wednesday or Thursday of the current week We will not hold our option contract. We will not hold shares during the reporting of Nike. The reason is earnings is so volatile and scary and risky, but we can maximize potential and earnings, and we can basically take advantage of the hype leading into the earnings week. So if you see a company like Apple reporting earnings a week from now, or Microsoft reporting earnings a week from now, guess what? You buy the option contract not expiring that week, but maybe 1 week or 2 weeks after that week. And guess what? If they do beat, you will make significant money. Just don't hold throughout the earnings report. Sell the day before. Like I mentioned in the beginning of the video, you can sell your contract the same day you buy your contract. You do not need to wait until the expiration date. That's a wrap, ladies and gentlemen. Thank you for all the support, the likes, the comments, the questions. I appreciate you all so much. I hope this has been so informative, and I hope that you can continue to earn money and wealth, and we can make this money together. Any questions, leave them below. Please share my first video, the fundamentals and the basics of options trading. I promise you, they will not regret learning this knowledge. It's all free. I'm doing it for free out of the kindness of my heart. So, hey, good luck, fellas. Good luck, ladies and gentlemen. I'm here for you. Salute.